Paul Bouchey, let's talk about the 5 fallacies of international investing. And the first one is that you need boots on the ground to know which stocks are best. Why is this wrong?
Well, investment managers love to portray themselves as superheroes. So they have the abilities to predict the markets. They tour the entire world, visiting factories, finding information that other people don't have. And it's just a fallacy. If you're going to do a private equity deal, or you're going to invest in an infrastructure project, yes, you need local knowledge. If you're going to invest in a publicly traded stock, you don't need boots on the ground.
Another misconception about international investing that you point out is that you should avoid the state-owned enterprises. You consider them low quality. Why is that?
Well, sometimes you see these pictures of vast open office spaces with people sleeping at their desk, and these are communist era companies who are bureaucratic. On the other hand, a lot of them enjoy monopoly powers and are either explicitly or implicitly backed by the government. So it's not immediately obvious that these are terrible investments going forward. And at any rate, a lot of the indexes will float adjust the weighting of these securities. So if you're in an index or a smart beta index or strategy, often these kinds of companies are downweighted anyway.
All right, well, the third myth of international investing that you point out is that you need to maintain a high active share. So what's an active share, and why is this a myth that you need to have a high one?
Yeah, it's a measure of concentration of the portfolio. So there's a push by a lot of consultants to find active managers that are going to invest in 50 stocks or 100 stocks. And the idea is this level of concentration will improve your excess returns over the benchmark or the market. And there's really no relationship when you look at the universe of active managers and you look at the concentrated ones versus the more diversified managers. There's no relationship with excess returns. So that's a fallacy right there, that you can just pick concentrated managers. And in fact, we find a lot of concentration even in the indexes. So in the emerging markets index, over 50% of the passive index is invested in 3 countries, China, Korea, and Taiwan. So there's concentrations everywhere, and our philosophy at Parametric is to have a more diversified approach.
All right, well, 2 more myths. One is that you need to know about the macro environment of the country you're investing in. So if I'm investing in Venezuela, you don't think I need to know what's going on in the macro economy in Venezuela?
Yeah, I mean, there are uses for macroeconomics, but predicting the stock market, it just doesn't have a good track record of predicting stock market movements. So understanding what's going to happen to the GDP long term of the country is quite interesting. Understanding GDP forecasts over the next quarter, not really useful in predicting stock market returns.
All right, and then the 5th fallacy, you don't think I need to pay attention to the politics in Venezuela or wherever it is either. Why not?
Yeah, I mean, I think that there's politics obviously has an impact on the market, but it's not an obvious relationship. So, for example, when Russia invaded Crimea, the stock market was down 10% that day. So that was a very clear war bad. But what was the return over the next 12 months? Russia was up 40% over the next 12 months. So it's not clear the relationship between politics or even headlines that you see in the media and stock market returns. So people often have kind of knee-jerk reactions, and you just have to be more cautious and more thoughtful.
Well, thanks a lot, Paul.
Yep. Cheers.
And thank you for watching The Street.